I got a question for you, Matthew, related to this. And by the way, thank you for being here. And I really enjoyed your podcast with Toby Carlisle. Um, so related to kind of the animal spirits and the psychology and the errors, and it's like you said, the systems are kind of designed to get you to trade. What do you, as a fund manager, do to manage your own personal cognitive biases and to make sure you don't fall into kind of cognitive traps? Do you have a active strategy you use to try to manage that?
Yeah, I do. I don't go in the brokerage account.
Nice.
so so uh, you know, it becomes a bit. It's a bit of a personality type, but it becomes a bit easier if you truly have a really concentrated portfolio. So, uh, years ago, I did an analysis and I did a little. I spoke about this at a conference out in Switzerland, and I did the speech I gave, I think I called diversification versus diversification, and it was all about the Kelly criterion, and and basically John Kelly back in the day, maybe the 1940s, came up with this formula for transmitting uh, telephone signals through the line, and they needed the precise amount of transmission to have it show up, but it doesn't need to be perfect. It just needs to be audible. And so there was a formula that he came up with that maximized this transmission. And it turns out it worked really well in Vegas. And the formula basically said, if you have a fixed pool of capital, which is what you have if you have a portfolio, and you know what you're going to get, you know what you're going to win when you're right, you know what you're going to lose when you're wrong, and you know the odds of being right, and you know the odds of being wrong, you can have a very objective capital allocation strategy. And the problem is, it works really well in a game like blackjack, where you can just calculate the odds. But in finance, you just simply can't calculate the odds very well. It's still subjective, even though I may think I'm going to be right and I'll have this sort of return. There's still subjective nature. So I inverted this whole problem because it hadn't really been looked at. I couldn't find any data on it, but it hadn't been looked at in a long time. And when John was doing his calculations, it was like punch card type calculations. And so I just opened Excel and I just solved for all of the possible parameters. So I said, from being 100% positive to being 0% confident that will be up, to having 4x returns, to having 0.0001x returns, and I just populated a massive spreadsheet and realized that based on the Kelly criterion, the optimal position size is between 10 and 50% of your portfolio. And so once I had that knowledge, and this has nothing to do with volatility, right? As you get concentrated, you do have more volatility. But it became very clear that if you want to outperform, you need to have just a very few, very solid, great ideas, and you can stick those in your portfolio and watch them for many years. So if you have a truly concentrated portfolio of 10 or so holdings, I think you transact less, because it's a very big decision to like sell 10% of your portfolio and then change entirely into a new position. So that in itself is very valuable. And again, it might be personality type, but understanding deeply that concentration is the way to run capital properly helps with the sort of tinkering and trading that interferes with a lot of people's success. I'll tell you, the hardest thing in many cases, people ask me quite often, what's your process to buy? And we do have a great process. It starts with this 13F analysis and fundamental analysis and all these things. But realistically, buying isn't really the problem. There's always ideas out there. There's things that we can research. There's attractive opportunities. it's really not selling that is much more difficult. So you can imagine if Graham had just sold Geico, or if Buffett had sold, I mean, you could argue maybe Buffett had been holding Coca-Cola for too long, but you know, all of these things could have been trimmed when they looked fully valued, and you know, there wouldn't have been nearly the success. So the selling discipline is really critical.
Follow Matthew Peterson at his website and YouTube channel with the links included in the video description below. If you have enjoyed this video, please smash the like button below and subscribe to our YouTube channel. Join our investment forum at Facebook. Link in the description below.